Folks, I'm going to talk today about how you can make money with credit spreads in any type of market. And that's what I really love about credit spreads. Like, let me give you an example. We're looking at the S&P 500. This is the SPY version of it. So there's the SPX and there's the SPY. The SPY is an ETF that you could actually trade and not just look at the S&P 500. So as you could see, the SPY's been going everywhere. I mean, we're talking 340, we're talking 220, we're talking 282. It's been a wild ride. And the thing about it is, a lot of traders don't know where the market's going to go. I could show you 15 articles right now talking about market going higher. I could show you 15 gurus talking about market going lower. And I could probably show you 30 articles or videos about market going sideways. No one has a clear direction of where the market's going to go. Everyone's got a lot of opinions. I have a lot of my own opinions. You might have heard some of them. But the truth of the matter is, no matter how you look at it, it's much easier to figure out where the market is not going to go than where it is going to go. Much easier, especially if you can put a time limit to it. If I say if the market's at 50 and I say the market's not going to go to 100 within the next 100 years, well, that's a little unrealistic. But what if I put a time clock? And what if that time clock's like 8 days, right? That changes everything. So for example, let me give you a really good scenario. Again, we're looking at the SPY ETF. This is a tradable version of the broad market. It has 500 of the biggest stocks, but we're going to try to play this game called figure out where it's not going to go and try to pocket money while doing it. Not a bad game, right? I love it. I play it all the time. So let's say the market's right now at 282. And let's say that we believe, this is all hypothetical, just to prove a point. I don't know if the market's going to go higher, but let's assume that we know something, or we think we know something. Let's assume that earnings are going to come out this week. Let's assume they're going to be bank earnings. Let's assume they're going to be the worst earnings that we've seen since the Great Depression. And let's assume the market's going to go down. Not a bad assumption, right? It's possible, right? Okay. So let's say we assume the market's going to top out right here at 283. That's it for the next 8 days. Not too hard to imagine, right? So we go to our options. These are call options, and these are going to expire this month on the 22nd. Only 8 days away. And the price was 283, right? It's right now at 283.06, and it's up 2.69% for the day. And let's just make this assumption. We're going to say, that's it. You're done climbing. So we're going to take a look at the 285 strike price, right? And the 287 strike price. Now, if you look at the midpoint, the difference between the 285 and the 287 is about, let's see here, 26, 39. It's about 90 cents. Let's just say 85 cents. That's $85 a contract. 10 contracts, that's $850 added to your account, and we're at 183. We're assuming that the market's not going to go above 285 in the next 8 days. Not that bad of an assumption, right? And if you're right, you get $850 in your account immediately, just like that. How about another scenario? How about we assume that the market's not going to go below 270, all right? 270. Let's say that we believe it's going to go between 283 and 270. Well, for the next 8 days, we can go to the put side, right? We can go ahead and we can just go show all here. And I want to show, I'm doing all this in real time. This was not preconceived. I didn't figure all these numbers out beforehand. I'm doing this in real time. So we believe the market's going to stay between 283 and 270. So we go to the put side and we go to 270. The 270 puts, are 236. So we sell the 270 puts and we buy back, in case of emergency, 267 puts. Now that's about 40, 5 cents right there. 184, 236. Let's see here. Yeah, that's a little above 50 cents. Let's just say 50 cents and call it a day. And that assumes that the market within the next 8 days is not going to go below 270. Now, what if we assumed that the market was going to stay between 283 and 270? Well, we can collect that premium from the upside and the premium from the downside. What do we say here? 85 cents. What do we say down here? 50 cents. 85 cents plus 50 cents is $1.85 plus 50. It's $1.35. $1.35 times 10 is 10 contracts. It's $1,135. All right? Not bad, right? Pretty good. Over $1,000, give or take between $1,000 and $1,200 by assuming that this market is going to stay between 283 and 270 over the next 8 sessions, which is very, very believable. I mean, it's very possible to believe this market's going to stay sideways. And think about this, because the market can't in 8 days, when this expiration date comes, 4/22, can the S&P be both at 283 and at 270? No. It can't be here and here, right? It can't be 2 places at once. Guess what? Your margin clerk is onto that. He knows that. And that's why the margin for both of those positions is only one margin. He'll take the biggest margin from both sides and use one of them, because the contract, the S&P 500, can't be at 283 and 270 and expiration on April 22nd. Can't happen. So again, these are easy, and once you figure them out, you're always buying and selling one. It's always a hedge strategy. You always know your maximum profit. You always know your max risk. You always know your max downside. You think market's going to go down? Just do one side. Do the bear call side. You think the market's going to go up? Do the bull put side. If you think the market's going to stay sideways, do them both. It's called an iron condor. The bottom line is, credit spreads allow you to take advantage of the market where A, you don't know where it's going to go. B, remember, the market stays sideways 75% of the time and allows you to take advantage of B, sideways markets. So, allows you to take advantage of the market where you don't know where it's going to go. B, allows you to take advantage of the market when it's going to go sideways. The stock market is trades sideways about 70 to 75% of the time. So iron condors and credit. Iron condor is just a fancy name for a two-sided credit spread that expires in the same day. It's a bear call spread, bull put spread. And again, you know your expiration date, you know your max risk, you know your max profit. You get your max profit right away into your account. You know it all up front. You know your break even, you know everything up front. There's no better way to position yourself than to know what you're going to do ahead of time. And credit spreads and iron condors, I love it. They give you the opportunity to do that irrespective of what the market's going to do. You can always create a credit spread to take advantage of the current market cycle. Folks, I'm leveling the playing field. Uber wealthy insiders are utilizing a strategy. This strategy enables them to earn 2, 3, even 4 times what regular traders make. And that's just not right. So I'm taking them head on and placing their money-making machine into the hands of everyday traders just like you. In today's presentation, I'll show you how to turn this privileged information into enormous paydays, like $1,700, $2,240. How about $4,750 on stocks such as Amazon, Google, even Tesla? Don't let this opportunity slip you by. Click on the button below or the one that follows this video to get in on this workshop. Do it now.